So good morning everyone. Welcome to the class. In the previous class in the portfolio management, we have studied about what investment is all about, what is the logic of doing investment, where we can do investment, and probably whenever we talk about investment, so we need to talk about stock market. Our knowledge about stock market is very essential at the time when we talk about investment. So basically, when we talk about the stock market is all about a medium where the stocks of different companies are trading once the IPO is over. So once the IPO is over, and they have given the ownership of their company to infinite individuals who can be interested to be the part of the company, because they are interested to be part, they can become the part of the company, either participating in the primary market in IPO, or probably they can be the part of the company in secondary market where they can buy and sell the shares of the company through the stock market. So primarily in India, we have two stock exchanges, Bombay Stock Exchange and National Stock Exchange, where we can go and we can buy shares of different companies of whom we are expecting a positive momentum. Okay, so in order to trade in stock market, you need to have a Demat account. So you need to open a Demat account in order to trade on the stock market. Demat account basically means a dematerialized account. So Demat account basically means dematerialized account. So physically, you cannot buy or sell in shares. So if you want to trade on the stock exchanges, first thing what you need to do, you need to create a Demat account. So basically, Demat account, which stand from dematerialized account. So we have two institutions in India, which works under the SEBI, Securities Exchange Board of India, to promote dematerialization. Those two bodies are NSDL and CDSL. So we have these two bodies. NSDL stand for National Securities Depository Limited. So we have these two bodies called National Securities Depository Limited. National Securities Depository Limited, and then we have the another body called Central Depository Services Limited. So we have these two bodies, NSDL and CDSL. The objective of these bodies is to promote a dematerialization in the stock exchanges. So once the SEBI came in picture under the SEBI Act of 1992, the current chairman of SEBI is Ajay Tyagi. So once the SEBI came in picture, the SEBI wanted that all the individuals who do trading over the stock exchanges, compulsorily they should do trading through Demat account only, through dematerialized account only. So they wanted to make a process, that process called dematerialization. Dematerialization means conversion of paper back security into electronic form securities. Everything should follow dematerialization. That was the objective. So with that an objective only, NSDL and CDSL has been initiated or has been industrialized in our country, so that the individuals can only use the medium of NSDL and CDSL to trade over the market. Now NSDL and CDSL will not come to you whenever you want to start trading in the market, and but on behalf of NSDL and CDSL, you have someone called a depository participants. You have someone called depository participants. So depository participants are the brokers. Brokers means your stock exchanges. Depository participants are basically these brokers like Zerodha or Angel Broking or Motilal Wal, or Sher Khan or India Bulls or Rally Gear. These all will become the depository participant. Uh, why they become depository participant? Because because in order to trade in the stock market, you need to have a Demat account, and Demat account is given to you by NSDL and CDSL. So, but NSDL and CDSL cannot reach to you whenever you want to open a Demat account. So basically, these institutions like your brokerage houses, either you talk about a brokerage house, either it is Angel Broking or Motilal Oswal or Sher Khan or India Bulls or Gear or or money control, or whichever anyone. So anyone wherever you open your Demat account, so they basically help you to open a Demat account, and once you have a Demat account from them, then you need to do the trading. Why you open a Demat account under NSDL or CDSL? Because you want to do trading in the market. So because you want to do trading in the market, that's why you have opened a Demat account. So once your Demat account is open, then once you start trading, so you as an individuals, you cannot trade directly over the exchanges. So you need a medium of the trading platform. That medium will be provided by these brokerage houses. So these brokerage houses first, free of cost, they will open Demat account for you. Like for internship right now, for your internship, if you go to different brokerage house like in Silkboard Signal, India Infoline office is there. Then near to corporation, Stock Holding Corporation of India is there. So in everywhere in around, we have lot of brokerage houses are there. So if you go to them for your internship, saying that, sir, I'm a finance student and I want to do internship, the first thing they will do, they will tell you to open these many Demats accounts. They'll give you target. They'll give you this much target. They'll tell you to make sure that in a month you need to make the people to open these many Demat account. Why Demat account? Because Demat account is the entry. It's the entry gate of trading. So before Demat account, you cannot trade in the stock market. So if once you have a Demat account, then what is the point of having a Demat account? The point of having the Demat account is that you want to trade in the market. Once you start trading in the market, so for every trading you do, you give a brokerage amount to your different brokerage houses. From that, the brokerage houses earns money. So I hope you are getting the logic behind why brokerage houses promote opening of Demat account, because once you open a Demat account, like I have a Demat account with Edelweiss. So yeah, I have a Demat account with Edelweiss. So whenever I want to do trade, I'll go to the app of Edelweiss or I go to the website of Edelweiss and I start trading over them. So it depends. So like wherever you open a Demat account, they'll give you different facilities, and they'll give you advanced brokerage and other concept, and then what you can do, you can start trading on them. So whenever you do trading, either you do day trading or you can do long term trading. Whenever you talk about long term trading, for that the brokerage amount will be more. If you do day trading, for that the brokerage amount will be less. Okay, so you can start trading on the market once you have a Demat account. Probably then that would be the best medium to start trading over the market. So a Demat account is basically favored by these two bodies. One is NSDL, the other one is CDSL. So basically, whenever you want to trade, whenever you want to buy certain stocks in the market, either you can do it by participating in the IPO of the market. So whenever you participate in the IPO, so basically the common assumption of participating in IPO is that the company will definitely will give their share at the discounted price in the IPO. Okay. So once the IPO get over, so once like after 12 days when the company get listed on the stock exchanges, then definitely the price of the share will go up. And when the price of share will go up, if you want, you can sell your investment, whatever you have, to get back from it. So that is a common assumption by which normally the people participate in the IPO, because IPO is like a sale. Like suppose a new shop is opened in a locality, so the initial first is the you expect that the shopkeeper will give you discount on different product so that the people get attracted to come and do shopping from that product. That is a common assumption what normally we use whenever we see anything starting new. So IPO is something like the same thing. So once the IPO of the company is over, once the company become a public company, and then every quarterly, every half yearly, every month, every quarterly, every half yearly, every annually, when the company keep on publishing their data, their financial statements, then each and every individual get enough in knowledge about the stock of the company. As by that they can take decision either should they buy the stocks or either they should sell the stock, and gradually that help them to do trading in the market. So whenever you do trading in the market, you have millions of stocks which you can see, which they are, every day they are going up or they are going down, and based upon them you can take decisions either to buy the stock or either not to buy the stock. So primarily these stocks which are trading in the market, you can talk about these stocks either on the term of the business model, or either you can talk about the stock in the term of the market capitalization. So yesterday I told you, so based upon the market capitalization, I can divide a company stock either into three parts. Either they belong to large cap companies, or they belong to mid cap companies, or they belong to small cap companies. So the top 100 companies are called large cap companies. Okay, 100 to 250 companies are called as mid cap companies, and below them we call them as a small cap companies. Based upon the business model, I can divide all the companies which are trading over the exchanges. Either they belong to different business model, either they may belong to IT, or they belong to banking, or they belong to pharma, or they belong to FMCG, or they belong to oil and gas, or they belong to media, or they belong to cement, or they belong to heavy goods. So depending upon their business model, you can divide them that they can belong to different sectors. So basically, when you see stock exchanges around you, like here you can see some new there's new index is being created. So there are a lot of stocks are there. You see there are a lot of stocks are there, and which are trading over the market. So you can bring different stocks together, and you can create an index. You can see this on your screen. Like so many indexes are there. So every index is being created within logic. So every index is being created within logic. So multi-factor index, then Nifty mid cap 150 quality 50 index, Nifty 50 equal weight index, Nifty 100 equal weight index, Nifty 200 momentum 30 index, Alpha 30 index. So you can create multiple indexes depending upon every index will have their own logic, like PB. PB means price to book value ratio. PE means price to earning ratio. So by using different strategies, like different indexes are there. So what is index? That is given information. What is index? I told you. So depending upon your perception about the market, depending upon that can be the good strategy for doing trading in the market. You can create an index. So what is index? Index is used to give information about the price movements of the products in the financial commodities or any other market. Financial indexes are constructed to measure the price movement of stock, bonds, treasury bills, and other forms of investment. Stock market indexes are meant to capture the overall behavior of equity market. A stock market index is created by selecting a group of stocks that are representative of the whole market or a specified sector or a segment of the market. An index is calculated with reference to the base period and base index value. I hope you remember. Yesterday, I gave you an example about Nifty. So how Nifty is being calculated, like that, there are so many indexes are there. So you can create your own indexes. So your indexes can be sectorial index. You can see Nifty Auto Index. So here all the automobile indexes, all the automobile stocks are there. Banking index, where all the banking stocks are there. Consumer durable index, financial services index, FMCG index, IT index, media index. So what you need to understand here is that whenever you want to understand the Indian market, don't simply look at Nifty. So Nifty is right now at 11,300, and suppose I have done investment in Infosys. Suppose my investment is on Infosys and Nifty is going up by 0.65%, doesn't mean that my stock is also gone up. Okay, so you need to understand that you need to look into the different indexes where probably your stocks can be present, and based upon that you need to understand the market. So Nifty 50, when you say Nifty 50, Nifty 50 is a portfolio of top 50 large cap companies which we that they represent the Indian economy. Okay, so the momentum of Nifty 50 mean that doesn't mean that the stock where I have done investment is also behaving the same way. Okay, so if you want to measure the performance, if you want to measure the performance of your stock with respect to the performance of the market, then we use a factor to measure that we called as a beta. So normally we look into something called a beta of the stock. So beta is very important factor. So beta it measures the systematic risk on a stock. So beta is basically it measures the systematic risk on a stock. Beta is basically it measures the systematic risk on the stock. It calculates the sensitivitiness. It calculates the sensitivitiness of the movement. It calculates the sensitivitiness of the movement of stock. It calculates the sensitivitiness of the movement of the stock with respect to the movement in market. So with respect to the movement of market. So when I say market with respect to the movement of market, so when I say market, market basically means Nifty or Sensex. So we use this term called market. So market here basically means Sensex or Nifty. So the performance on Sensex and Nifty that we call as a market. So market so whatever the returns the market gives you, that we believe is the best return. So there's a theory proposed by Eugene Fema that was called efficient market hypothesis. So as per the efficient market hypothesis, the returns what is giving the return what is given by you by market, that is the best return. So you can never beat the return of the market. So that was the theory which was proposed by the Eugene Fema. Then do whatever, but you can never beat the market. So basically, what is beta? Beta is basically it is the slope of the regression line. You remember? I hope you remember the regression. So I in the statistics, business analytics and operation research, the first semester I have taught you regression. So what is regression? So regression is basically the relationship between an independent variable and a dependent variable. So what is beta? So beta is the factor which measures how sensitive is your stock with the sensitivity market. So whenever the market is going up, so is your stock is also going up. When the market has fall down, is your stock is also fall down. All that is basically measured by beta. So beta is the factor which measures how sensitive is my stock with respect to the sensitivitiness of my market. So beta is the very important parameter. So whenever we are analyzing stock, so when analyzing stock, whenever I want to know that whenever like I want to know that if suppose if I'm seeing here Nifty, that Nifty has went up by 0.65%, I want to know what has happened to my stock. So Nifty has went up by 0.65%. I want to know Nifty has went up by 0.65%. I want to know what has happened to my stock. So is my stock has also went up because Nifty has went up by 0.65%. So if my stock is also went up or my stock has went down, so what has happened to my stock? So for that, I just need to look into the beta of my stock. Okay. So beta is basically, it's a, when we say beta, it measures the regression relationship between the movement of stock with respect to the movement of the market. So that is basically we called as the beta. So it is the slope. It is the beta is basically, it is a slope of, regression. It is a slope of regression relationship. It is a slope of regression relationship of the return of a stock, of the return on a stock. It is a slope of regression relationship of a return on the stock with respect to the, with respect to the return on market, with respect to the return on market. So that is basically we called as a beta. Beta is one of the very important factor on which you can expect, definitely in exam you will get a question about calculation of beta. So how you can work on the calculation of beta. So that is something which you need to understand. So basically, whenever you want to measure the beta of a stock, whenever you want to measure the beta of the stock, you can use the formula called covariance between stock and market. You can use the formula called covariance between stock and market, divide by the covariance between stock and market, divide by the variance of market. So you can use this as a formula. Covariance between stock and market divide by the variance of the market. You can use this as a formula to calculate the beta of the stock. So covariance, I for whenever covariance is given, so so I hope you remember the formula. Covariance is nothing but coefficient of correlation between stock and market into standard deviation of stock into standard deviation of market divided by the variance of the market. So with this I can calculate the beta of the stock. So with this I can write coefficient of correlation between stock and the market into standard deviation of stock by the standard deviation of market. So this can be one of the formula to calculate the beta. So this all we have done in first semester, business analytics and operation research. We have done all this thing. We have studied all this thing, covariance formula. So you can calculate the beta of the stock by using this formula. So the formula is covariance between the stock and market divided by the variance of the market. So this is the formula of the beta of the stock. So I hope you remember the formulas and all. What is the formula of standard deviation of stock? So the standard deviation of stock I can calculate by the formula called summation of here in place of x, summation of s minus s bar whole square divided by n. Hope you remember. Okay, so the standard deviation of market you can calculate by the formula called summation of m minus m bar whole square by n. Okay, so where m is the return on market, s is the return on stock. To calculate the coefficient of correlation between stock and market, I hope you remember the formula coefficient of correlation n summation of s and m minus summation of s into summation of m divide by square root of n summation of s square minus summation of s whole square n summation of m square minus summation of m ka whole square. So already we have studied all this formula. We have studied this formula. I hope you remember them. So you can use this, or you can use covariance formula, that is summation of s minus s bar into m minus m bar. This is covariance divide by the, this is covariance divided by the variance of market. So the variance of market is m minus m bar whole square. नहीं नहीं, कोएफिशिएंट ऑफ कोरिलेशन क्या होता है? कोएफिशिएंट ऑफ कोरिलेशन is covariance divided by standard deviation. So this is standard deviation. This is standard deviation. So I'm writing the formula of coefficient of correlation. So, so, so these all are the formulas which I believe you still remember. We have done very few months back only. We have done all this. So I hope you still remember them. So basically, you should remember what is beta. So beta, how will you calculate the beta? So beta of the stock, it is nothing but it is a covariance between stock and market divided by the variance of the market. So the direct formula you want to write n summation of Sm minus summation of S into summation of M, summation of S into summation of M divide by n summation of M square minus summation of M the whole square. This is a direct formula. To calculate the beta of the stock, this is a direct formula to calculate the beta of the stock. So it basically measures the covariance between stock and market divided by the variance of the market. That is that we called as the beta. That we called as the beta of the stock. So it basically measures the covariance. So covariance. I hope you remember the formula of covariance. So covariance between stock and market would be nothing but coefficient relation between stock and market into standard deviation of market into standard deviation of stock. So basic, whatever we have studied in statistics, so basic knowledge if we have that, then it would be good for us. So when we talk about beta, so beta of a stock basically talks about how sensitive is my stock with respect to the movement of the market. Okay, so whenever we see the market basically means Sensex or Nifty. So Sensex or Nifties are going up or going down. So how sensitive is my stock with that movement of the market? That is what the beta basically measures. So whenever you talk about the beta of the stock, whenever we talk about the beta of the stock, so if the beta of the stock is 1, so if the first beta of the stock can be either positive, beta of the stock, it can be either positive, so the stocks can be positive beta stock, so the stock can be positive beta stock, or a stock can be negative beta stock. So whenever you talk about a stock can be positive beta stock, it can be negative beta stock. So positive beta stock are those stocks which moves in the same direction of market. So market going up, the stock going up. So the market going up, stock going up. So market going down, the stock going down. So those are called positive beta stocks. So whichever direction the market moves, the stock also moves in the same direction. So those are called positive beta stock. Negative beta stock means the market is going up, the stock is going down. Okay, the market is going down, the stock is going up. So they are called as negative beta stocks. So negative beta stocks are those stocks which moves in the opposite direction of market. So negative beta stocks are those stocks which moves in the negative direction of market, while positive beta stocks are those stocks which moves in the same direction of market. So I hope you got the logic that whenever you talk about the beta of the beta of the stock can be either positive or the beta of the stock is either negative. So positive beta stocks are those stocks. Positive beta stocks are those stocks which moves in the same direction of market, which moves in the same direction of market, which moves in the same direction of market. They are called as positive beta stock. Negative beta stocks are those are those stocks which moves in the opposite direction of market, which moves in the opposite direction of market. Negative beta stocks are those stocks which moves in the opposite directions of market. Those stock which moves in the opposite direction of market, we call them as a negative beta stock. Positive beta stocks which moves in the same direction of market. So I hope you understood. So either you can talk about beta in the term of the directions, or you can term of the value. So beta of the stock, beta of the stock can be beta of the stock can be equal to 1, or it can be beta of the stock can be more than 1, or the beta of the stock can be less than 1. So whenever you look into the beta of the stock, it can be equal to 1 or more than 1 or less than 1. So beta of the stock, if it equal to 1, it means what that mean? It means that it means if market change by, if market 1 means if market change by 10%. The 1 basically means if the market change by 10%, the stock will also change by 10%. So 1 means the same magnitude. If the market change by 10%, the stock will also change by 10%. That means 1. 1 basically means same change, same magnitude. So basically, beta is nothing but it measures the change in stock with respect to the change in market. So if the beta is 1, that if beta is 1, then whatever the magnitude the stock changes, the market changes, the stock also change by same way. So like if you beta is -1, beta is minus 1 means beta is -1 means your market went up by 10%, your stock fall down by 10 minus 10%. Stock fall down by 10%, beta -1. Your market went down by 10%, stock went up by 10%. So that means the beta of the stock is -1. That means the beta of the stock is -1. So if the beta of the stock is -1, it means that if the market went up by 10%, the stock went down by 10%. The market went down by 10%, the stock went up by 10%. That means the beta of the stock is -1. Okay, so that means that the beta of the stock is -1. So minus sign means opposite direction. Plus sign means the same direction. So whatever is happening in the market, the same thing is happening with the stock. Okay, so that depends on the sign. Plus means so the stock and the market both are changing in the same direction. Sign is minus means whatever direction the market is changing, the stock is changing in the opposite direction. So I hope you understood this. Now, if the beta of the stock is more than 1, suppose the beta of the stock is 1.5. Suppose the beta of the stock is 1.5. Suppose the beta of the stock is 1.5. What that mean? That mean that if the market went up by 10%, the stock has went up by 15%. Okay, so if the market has went down by 10%, the stock has went down by minus 15%. I hope that you got the logic. So more than 1. So those stocks which have beta more than 1, they are very sensitive with the change in market. So whatever the percentage the market will change, the stock will change by more than that percentage. So beta of the stock is less than 1. So beta of the stock is less than 1. Suppose 0.5. Suppose beta of the stock is 0.5. If what that mean? That mean that if the market has went up by 10%, the stock has went up by only 5%. If the market has went down by 10%, the stock has went down by 5%. Here the beta of the stock is 0.5. So I hope you got the logic about the beta. So I hope you got the logic about the beta. So beta basically measures the sensitiveness of the stock with respect to the sensitiveness of the market. Okay, so how sensitive is the stock with respect to the sensitiveness of the market? That is what the beta measures. So beta is the factor. So by looking at the beta of the stock, I can understand a lot about the stock. So basically, beta is the relationship between the stock and the market. So if I see the current Nifty, if I see the current Nifty, that Nifty has went up by like suppose 0.27%. Right now, Nifty has went up by 0.27%. So if the moment I see this, and if I know that my stock is a positive beta stock, so I understood that if Nifty has went up, definitely my stock would have also went up. Okay, so if Nifty, when I see Nifty is going down, so automatically I believe that stock is also going down because my stock is a positive beta stock. Okay, so basically, whenever we talk about beta of a stock, normally because beta is the regression relationship, it's not a correlation relationship. Beta is a regression relationship because regression is a relationship between two variables where one variable is dependent on the other variable. So whatever is happening in the market is directly or indirectly will affect the stock. So whatever happening in the market will definitely will affect the stock. So normally the beta of the stocks normally are positive only. So you will not find stocks having negative beta. So normally for large cap and mid cap stocks, you don't find the beta to be negative. Okay, but for the small cap, the beta can be negative because small cap stocks are little bit risky to do investment. So whenever you try to do investment on small cap companies, your brokers will definitely will guide you that because in small cap company the momentum is very fast. So you can see lot of momentum in small cap company because small cap company their prices are less. Okay, the number of shares are also not so much. So because of which you can artificial ups and down in prices also can possible in the case of small cap stocks. So normally the ideal investors are being suggested to stay away from small cap companies till that time you don't find any kind of value stocks. So till that time you're not finding any kind of value stocks. Till that time you need to be little bit cautious whenever you do investment in particularly in small cap companies. So here when I see Nifty, here when I'm seeing Nifty, so what I can see here that how the performance of the Nifty is going to affect the performance of my market because Nifty is a portfolio of large cap companies. So is a portfolio of large cap company and definitely you can understand in your sector where whichever sector you stock is there, definitely the performance of your stock would be monitored by the momentum of what is backed by the large cap company in that portfolio or in that sector. So that is something which always be there. So normally those stocks which have beta more than one, those stocks which have beta more than one, we call these stocks as a aggressive stocks or risky stocks. So those stocks which have beta more than one, we call them as a risky stock, while those stocks which have beta less than one, so we call them as a defensive stocks. Defensive stocks. So like the example like FMCG or pharma. So FMCG, pharma, definitely if you see the beta of these companies, they are like used to be less than one. More than one risky stocks or aggressive stocks like real estate companies, real estate stocks or banking. So you see their beta usually more than one. So those investors who want to take more risk on the stock market, they can go for those stocks which have beta more than one. While for those investors who don't want to take uh, more risk in the market, they prefer to invest in those stocks which are less risky on them. Okay, so that kind of strategy, that kind of strategy, that kind of strategy you can keep in mind. So that is always there whenever we look into the investment. uh, so that is always there. So whenever we do investment, it's not like all stocks are equally risky. So because whenever you do investment in the market, it is a common perception of the trader that whenever we talk about investment in the stock market, we believe that the all stocks are equally risky. And so whenever you do investment, people say that don't invest in the stock market. So it's not like that. So all stocks are not risky. Uh, it depends upon the sector of the company, how sensitive is that sector with respect to the sensitivitiness of the market. So if the sector is very sensitive, so definitely the beta of that sector will be high. And those high beta stocks, if you do investment, you can see momentum in them. While if you want to go for long term investment, if you want to do long term investment, you can prefer to do investment in those stocks which have beta less than 1. While if you want to go for long-term investment, you invest in those stocks which have beta less than 1. While if you are a day trader, so you can prefer to invest on those stocks which have beta particularly more than 1. So that way there's a chance of getting good return, but risk is there. So like we know, we follow a theory called more risk, more return. So that is always there whenever whenever you look into them. Any doubt, anyone? Any question anyone want to ask? Anyone? Any question? So I'll show you how we can calculate a beta in the market. I'll show you. So like suppose I went to, so to calculate, right now I'll show you in Excel. Tomorrow I'll show you how to calculate the beta. So like in exam, this question has came, question number 6C. You can see this question. You can see this question number 6C. The rates of the return of stocks and market portfolio of 50 periods are given below. So what is the beta of stock A? So this question we'll do tomorrow. So right now I'll show you in MS Excel how will you calculate the beta of the stock. So for that go to NSE website, and from there you can go to NSE website, and you can go to historical data. And here in historical data you click on search, and here you can choose a time period. So today is 29, so maybe 29 6. So 6 means June. So 29 6, 29 6 to today, I'll suppose 28. So here you can choose the data. So till yesterday, so it will give you the data. So here I clicked on this Nifty. So I got the data of Nifty. So you can see this. Then I can download it. So this is the Nifty data. I got the Nifty data. So what matters to me is the closing value. What matters to me is the closing values. This is the Nifty data. So opening, highest, lowest. So what matters to me is only the closing data. I just want the closing data of Nifty. Similarly, suppose I want to compare with any stock. which stock can I compare? Suppose which company? Suppose Infosys. So I compare this with Infosys. I want to show you how to calculate the beta. So just an example, Infosys, you can see right now trading at 1024. So here click on historical data. So I can choose here 3 month, get data, download this. So you can get the data. So in MS Excel, you'll get the data. This is from 29 June and this is also from 29 June. Nifty is also from 29 June. So I got 3 month data for all of them. So once you get the 3 month data for all of them, so let me copy this. So I'm just copying the data here. This is from 29 June to 28 September. Take the closing price. So 29 June 2020, from 29 June to 28 September. This is the data for Nifty. This is the data for Nifty. Similarly, I'll come here. If you see here the data is from 28 September. So, but I have taken the data from 29 June. What you do? So make this date from oldest to newest. So now you get the date from 29 June. Now you got the date from 29 June to 28 September. Now the date is from 29 June. And here also you want 29 June. So this is the closing value of Nifty. This is the closing value of Nifty. So the closing value of Infosys you take here the closing value of Infosys, closing price. So now you got the closing value of Nifty, you got the closing value of Infosys. Now what you can do, you can calculate the return. You can calculate the return on Nifty. You can calculate the return on Infosys. So how to calculate the return? Return is nothing but calculate return today value minus yesterday value Okay, today value minus yesterday value. Today value minus yesterday value, divide by yesterday value into 100. With that you get the return. So you got the return on Nifty. So similarly you can get the return on Infosys. So once you get the return, if you want, you can write their values in percentage. So you can see the values in percentage. So once you get this, so if you want to calculate the beta of the stock, if you want to calculate the beta of the stock, so the direct formula is there for beta, that is called slope known y. So in Excel, you can do it directly. Slope right equal to slope known y's. Y means a dependent variable. X means independent variable. So what is dependent variable here? A return on stock, comma. So known x. X means independent variable. So the independent variable means return on the stock, return on market. So this, if you do this, you get the beta of the stock. This is the beta of the stock. So this is the beta of the stock. So you can do it directly. So beta of the stock. So tomorrow I'll do further on this. I'll discuss more on this. I've taken the historical data. So I have taken the historical data. On that historical data, I have taken the closing value of Nifty, and then I have taken the closing value of my stock on which I want to do research. Suppose I want to do research on Infosys, so I calculated the return. So I calculated the return on Infosys and return on Nifty, and then directly statistically you can calculate the beta, because if you remember I told you what is beta. Beta is the slope of a regression relationship between the return on stock with respect to the return on market. So how sensitive is the return on my stock with respect to the return on market, through which I can calculate the beta of the stock. Okay, so directly you can use this formula of slope, and through which you can calculate the beta of the stock. So if you see this beta of the stock, suppose Infosys is 0.733, so that means, for what you understand by this, that means this stock having the beta less than 1. So if this stock Infosys is having beta less than 1, it means that this is a defensive stock. It means it is a good stock to invest if you want to invest for the long time. Then next thing you need to understand that this stock, when you see Infosys, the Infosys will change by 7.33% if the market change by 10%. So if the market goes up by 10%, the Infosys will goes up by 7.33%. If market will go down by 10%, the Infosys will go down by minus 7.33%. Okay, when you see this beta, the beta is positive. Beta is positive means whichever direction the market is changing, this stock will also change in that same direction. Then the beta is less than 1. Beta is less than 1 means this is a defensive stock. You can invest this stock for long term. If you are a kind of investor who want to do investment for long term, you can prefer this stock for the investment part. So I hope you understood this. Anyone have any doubt, any question? Anyone, any question before I wind up the class? Guys, answer your attendance. Akash, Bharat, Akash, Bharat, Bhavna, Chaitanya is present. Darshan, Darshan is also present. Darshan, guys, attend your roll call. Darshan, please write in the chat box. Divya, Gitanjali, please uh, Darshan, Divya, Gitanjali, Harish Kumar. Guys, attend one by one. So Gitanjali is there, and Harish is there. Gitanjali is there. Gitanjali is there. Then Harish is there. Then Karthik. Karthik is also there. Karthik. When your turn come, then will you tell Karthik. Then Kauna. Kauna. Kirti. Kirti. Kauna. Kirti. Kiran MV. Guys, when your turn will come, then will you tell your attendance? How many times should I tell you the same thing? Kirti, Kiran, Mohan Kumar, Nagaveni, Pavan. Mohan Kumar is there. Mohan Kumar, Nagaveni, Pavan, Pavan, Prajwal is there. Prakriti, Prakriti, Darshan, Prakriti, Prakriti, Priyanka, Chaitanya, I gave you attendance already long back. Huh? Priyanka, Priyanka, then Rakesh, BS, okay. Oh, by mistake it happened. Huh. Hmm. Uh, Priyanka, Prakriti, Rakesh, Ranjita is there, Ravi Teja is there, Rohan, 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 Sachin, Rohan, Sachin, Sanjay, Sanjay, Shakib, Shalini, Shalini, Suraj Kumar is there, Virendra, Virendra Vidya, Virendra Vidya, Yogeshwari is there, Vidya, okay, Virendra Hegde, Virendra Hegde, anyone attendance? Vidya I gave, Bhavna I have given attendance, Bhavna, Bhavna done, then Chaitanya done, Darshan done, Divya done, Gitanjali I have given, Harish, Harish I have given now, Harish, Harish given, anyone else? Karthik I have given, Mohan I have given, Prajwal I have given, Priyanka I have given, then Rakesh I have given, Ravi Teja, Shakib, Suraj, Yogeshwari. Okay. So everyone attendance I have given. Anyone name if I missed? Akash, Bharat, then Kavna, Kirti, Kiran, Nagavini, Pavan, Prakriti, Rohan, Sachin, Sanjay, Shalini, Virendra. These are the absent today. Anyone? Clear everyone? Then we'll wind up the class today. Then thank you everyone. See you everyone then tomorrow. Karthik, I give attendance. Karthik, I have given you the attendance. Thank you everyone. See you then tomorrow for the class.